Stocks and shares are constantly going up and down in value. If you can't stomach this volatility, then you need to keep away. Well away. But if you do, you will regret it. Having your money invested in the stock market is the easiest way to make your money work hard for you, rather than you having to work hard for money.
We filmed this video during the beginning of the outbreak of the coronavirus and subsequent stock market crash. But by the time this video is published, the worst may be over. Or conversely, it could be far worse. Either way, we are confident that this is just another minor blip on the stock market's march to ever greater heights and gives you an awesome buying opportunity. Price volatility is your friend if you are brave enough to strike.
We don't know whether stock markets will be down further in 1 year's time, but in 5 years' time it is likely to be higher, in 10 years it is almost certain to be higher, and in 20 years plus it is practically guaranteed. And you will of course have collected some juicy dividends along the way.
And in a way, it's these dividends that reduce your risk of investing. The FTSE 100 hasn't had the best 20 years, which is why it's so important to diversify. And why we have always encouraged worldwide investing, as seen in our How to Own the World series. Other indices have fared much better over this time period, which highlights just how important it is to own everything.
Anyway, we've done some serious analysis on the FTSE 100, and our findings demonstrate that selling after a crash is the worst thing that you can possibly do. Let's check it out.
Welcome to Unshackled.com, the investment channel and website that says you and your finance is free. This is Andy, I'm Ben, and if you like what we have to say, hit the like button, click subscribe.
Don't forget to check out the Unshackled.com offers page, where we have hundreds of pounds of cash bonuses that you can snap up when you sign up to any of the investment and peer-to-peer lending platforms listed. We'll put the link to this offers page in the description below, so be sure to check that out. Let's get into the video.
FTSE 100. This is the FTSE 100 for almost 20 years, which shows a pretty bleak picture. But it at least shows that after every crash, it does eventually climb above its previous high. And to be honest, unless you had bought in at the peak of the market, it's not a problem at all. And by buying regularly, known as pound or dollar cost averaging, you average out your purchase price, meaning that your average purchase price is never at the top of the market.
By this logic, a big price fall such as what we've just seen in February 2020 due to the coronavirus gives us an incredible buying opportunity. It is this reason why Ben and I are always ready to pour more money into the market, which is exactly what we have been doing recently.
The market had crashed by about 10%, so we buy a little. If the market continues to crash, which we're very happy if it does, then we'll buy big. We consider a 10% fall to be a nice gesture from the market, but 20% or more and it's time to splash the cash big time. Sale is on. The
problem many people face is the emotional hurdle that stock market crash creates, which is why many successful investors automate their investing. I take advantage of Interactive Investor's free monthly investing service, so I don't need to worry about exact timing. But I also buy big when everyone else is panicking.
If we take another look at the FTSE 100 graph, we can see that it always recovers when people realise that it's not the end of the world. We're just showing you the data we could get our hands on, but we know this story goes back until the beginning of time, or at least the beginning of the FTSE 100.
FTSE 100 total return. Over time, we know that dividends, particularly when reinvested, are one of the biggest drivers of investment performance, so worrying about short-term price fluctuations is completely unnecessary. Here we're looking at the FTSE 100 versus the FTSE 100 total return index for about 7 years. Total return means that it also factors in the effect of dividends reinvested. From this graph we can't really see too much. It appears that the total return index just perfectly tracks the main FTSE 100 line.
However, we want to see relative performance, so a technique we can use is to rebase the graph. Each line now starts at the same point, which will show us the real story. We can now see that although the total return line still mimics the FTSE 100, it quite quickly powers ahead, and therefore the impact of small price fluctuations become less important, as the endpoint is leaps and bounds ahead of the starting value and your original investment.
This is a key reason why we can both handle large price declines comfortably, because we know that just by being invested in the market, it is going to make us lots of money in the long term, due to the power of dividends compounding our returns. We wish we had been able to show you a larger time period because the gap compounds and becomes enormous, but unfortunately, we couldn't get our hands on the data. Nevertheless, even in this 7-year period, the difference is still significant, with the FTSE 100 showing a return of just 10%. But the FTSE 100 total return index is returning around 50%.
Why selling immediately after a crash is stupid. Neither of the graphs we've looked at so far really demonstrate the size of the crashes and the speeds of the recovery. This graph shows the week-on-week percentage movements of the FTSE 100. What we can see is that whenever we see a period of sharp decline, this is always followed by a quick reversal soon after.
What we can see is large drops around 2001 relating to 9/11 and huge drops around 2008 due to the financial crisis. Then there's a crash in 2011 due to the debt crisis. The last 20 years is littered with crashes, and we're sure the coronavirus crash is just another blip on the graph, as all that preceded it have been.
What shocked us most from this graph is the speed of the reversal in the weeks that followed a crash. The end of September 2001 saw the FTSE rally 10.59% in 1 week. In 2008, there was a week where it climbed 12.72%, and another week shortly after, rallying a further 13.41%. The graph shows this pattern throughout the 20-year period. We're betting the same will happen again now and in future.
If you sell immediately after a crash, then you will miss out on all these incredible price rallies. Shockingly, people have very short-term memories, and previous impending dooms are long forgotten. When putting together this graph, we had to look up the reasons for the price crashes, because we couldn't remember either. But at the time, they would have been all front page news predicting the end of the world.
What about individual stocks? We're very confident that overall markets will continue to climb until the end of time, but we can't say this with confidence about individual stocks. The financial crisis saw the destruction of the banking sector, and on the most part, it never recovered.
When an index such as the FTSE 100 falls, that's fine by us. But individual stocks fall and often never bounce back. Stocks have their own unique characteristics, which means that they can become permanently damaged by whatever caused the price to decline in the first place.
For example, travel companies and airlines have had a particularly tough time recently. Who knows what a pandemic could do to the long-term prospects of a travel company? A ban on travel could cause losses to spiral, and the company could go bust before any chance of recovery. The difficulties of predicting the outcome is a major reason in why we both limit our involvement in investing in individual stocks.
What you should do nothing. Assuming you own well-diversified index trackers, do not sell. If you're the type of person who has an itchy trigger finger, then sometimes the best thing that you can do is not to monitor financial news, and these events will blow over before you've even noticed.
Buy, buy, buy! If you're a little braver, like us, then start buying when everything is on sale. As we've just seen in the graphs, very large downward swings don't happen very often. Make sure you're ready to take full advantage when they do. It's times like this that give stocks a huge advantage over less liquid asset classes such as property, because you can take advantage of lower prices before they rise.
Rebalance. Big swings will often leave your portfolio out of line with your intended allocation. This might be the time to rebalance. What this does is move money from the assets that have performed well, which perhaps have little room to grow, and allocates more to the past underperformers, which may have better opportunities.
Question of the day: how do you react during a stock market crash? Let us know in the comment section.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.